Welcome back to my videos. So on this video, we are going to learn about receivables. So receivable has a lot of topics. It's a huge topic. So we are going to prepare at least 5 videos to cover up the whole entire topics of receivable. So on receivables, we are going to learn about accounts receivables, notes receivables, loans receivables. We are also going to learn about the allowance methods in determining the bad debts expense. Also, the direct method, the direct write-off method of determining the bad debts expense. Also, we are going to learn about impairment of loans receivable. Also, we're going to learn about receivable financing. Remember the pledging, assignments, factoring, and discounting. These are all the topics of receivables. So we are going to prepare at least 5 videos to cover up all receivable topics. So on this video, we are going to learn about an overview of receivables. So what is a receivable? A receivable is a contractual right to receive cash or other financial assets. And we name our receivables in many ways. Depends on what kind of business a company has. For retailers and manufacturers, all right, we name our receivables for retailers and manufacturers as trade receivables and non-trade receivables. All right. For banks and other financial institutions, their receivable is called loans receivable. All right. So for retailers and manufacturers or any other businesses other than the banks and financial institutions or other financial institutions, the retailers and manufacturers receivables are called trade receivables and non-trade receivables. Trade receivables are contractual rights to receive cash from its customer or from other companies for goods or services that have been delivered or used. Okay, there are 2 kinds of trade receivables, and these are accounts receivable and our notes receivable. All right, so trade receivables are accounts receivable and notes receivable. For non-trade receivable, what is a non-trade receivable? A non-trade receivable are contractual rights to receive cash from sources other than from the ordinary course of business. All right, and some examples of non-trade receivables are how do we classify a trade receivables and non-trade receivables on our financial statements? We classify trade receivables and non-trade receivable either a current assets or non-current assets. So we classify this as current assets or non-current assets. So when do we classify a trade receivable as current assets? If we can collect this receivable within 1 year or within the normal operating cycle. All right, within 1 year or within the normal operating cycles, whichever is longer. All right, let me repeat that. We classified a trade receivable as a current asset if we can collect or we realize this receivable within 1 year or within the normal operating cycle. What does it mean? Whichever is longer. The normal operating cycle can be more than 1 year. So if it's more than 1 year, whichever is longer, we still consider that as a current asset. If the problem in the actual exam is the normal operating cycle is not given, then we assume the operating cycle is 12 months. When do we consider a trade receivable as a non-current asset? We consider a trade receivable as a non-current asset. We classify as a non-current asset if the collectibility of the receivable is beyond 1 year or beyond the normal operating cycle, whichever is longer. All right. So this is above 1 year or the normal operating cycle. Normal operating cycle. Above 1 year or above the normal operating cycle, whichever is longer. All right. Now, how do we classify a non-trade receivables? We also classify a non-trade receivable either current assets or non-current assets. So when do we classify a non-trade receivable as a current asset? If the collectibility of this non-trade receivable is within 1 year, we classify that as a current asset. And we classify a non-trade receivable as a non-current asset if the collectibility of this receivable is beyond 1 year or above 1 year. All right. So on trade receivables, we classify trade receivable either current assets or non-current assets. We classify as a current assets if the collectibility of the receivable is within 1 year or within the normal operating cycle, whichever is longer. Let's say, for example, if the normal operating cycle is 18 months and you have a receivable that is 15 months that is within the normal operating cycle, then we can still consider this as a current assets. If the problem in your actual exam doesn't specify the normal operating cycle, then we assume the operating cycle is 1 year. All right? Now, we classify our trade receivable if the collectibility of the receivable on non-current assets is beyond 1 year or beyond this normal operating cycle, whichever is longer. All right? Or if we cannot classify as a current assets, then we classify as a non-current assets. For non-trade receivables, we classify a non-trade receivable as a current asset if the collectibility of the receivable is within 1 year. Okay, we ignore the normal operating cycle when it comes to non-trade receivables. We don't care about the normal operating cycles because on non-trade receivable, this is a contractual rights to receive cash from sources other than the ordinary course of business. All right? On trade receivable, this trade receivable is created from the ordinary course of business. All right, from customers or other companies. Non-trade receivables, we ignore the operating cycles. We classify non-trade receivable as non-current assets if the collectibility of this receivable is beyond 1 year. And this is your trade receivables in non-trade receivables. For banks and other financial institutions, their receivable is called loans receivable. For loans receivable, we don't classify this as non-current assets or a current assets. Okay, we classify this according to their liquidity, and we will discuss loans receivable in a separate video. All right. Now, trade receivables, we have we have two kinds of trades receivable. We have our accounts receivable and our notes receivable. And we will talk or learn about accounts receivable in a separate video, as well as notes receivable in a separate video. All right? Now, let's talk about the financial presentations of the receivable. So remember, the trade receivable that is classified as current assets and the non-trade receivable classified as current assets, we can combine them both, and we will present that item as trade and other receivables. So the current assets, that is trade receivables, and the other current asset of a non-trade receivable, we can combine them both, and we will present them on the financial statements as trade and other receivables. And the details of the trade receivable and the non-trade receivable should be disclosed on the notes of financial statements. Okay? Now, there's another thing that I want you to learn in receivables. The normal balance of the receivable. So what is the normal balance of the receivable? So what is the normal balance of the receivable? The normal balance of the receivable is debit balance. So what do I mean? Everybody knows about T accounts, right? Let me give you a T account of an accounts receivable. All right, let me give you a T account. An accounts receivable from customer A has 100,000 balance on the debit side. That's normal. Accounts receivable from customer B, 50,000. And accounts receivable from customer C, 80,000. Let's say, for example, we collected a part of customer A's accounts receivable, or accounts receivable from customer A. Let's say we collected 50,000. So all in all, the balance on the accounts receivable from customer A is 50,000. All right. From customer B, we have accounts receivable of 50,000. Let's say, for example, we collected 20,000. So customer B still has a balance of 30,000. So we still have a collectible of 30,000 from customer B. Now, customer C, we have an accounts receivable from customer C and 80,000. Let's say, for example, customer A paid us 100,000. For some reasons, it could be overpayment or an error, or whatever the reason is. The accounts receivable of customer C, we have 80,000, but customer C paid us 100,000. So on this, we have a credit balance of 20,000. So the credit balance is not normal. So what do we do? This is a debit balance. And this is another debit balance. So when we present this in our financial statements, our accounts receivable from customer A, customer B, and customer C. If we ignore the credit balance on customer C, this is how we're going to present this accounts receivable. So if we ignore the credit balance of the accounts receivable from customer C, then the effect of this is offsetting this 20,000 credit from our debit balances. So all in all, we will have an total accounts receivable of 60,000. And this is not acceptable in accounting. So if it's not acceptable, what do we do? As an accountant, if we have a credit balance of our accounts receivable, we have to adjust this credit balance of accounts receivable. So we are going to have an adjusting journal entry. So what is our adjusting journal entry? Our adjusting journal entry will be debit to accounts receivable from customer C of 20,000 and credit to advance payment from customer C of 20,000. All right, so our adjusting journal entry will be debit to accounts receivable, customer C of 20,000. So we will zero out this account. Okay, then we will credit an advance payment from customer C, which will be presented as current liability. All right. And on our financial statements, we will report a accounts receivable of 80,000, not 60,000, but 80,000, and a current liability of advances from advance payment from customer C of 20,000. So the accounts receivable will be current assets and the advance payment from customer C will be current liability. All right, let me repeat that. The normal balance of receivable is debit balance. These are our examples. We have customer A, customer B, and customer C. Customer A has a debit balance of 50,000 as well as customer B has a debit balance of 30,000. But customer C has a credit balance of 20,000, and this is not acceptable. If we ignore the credit balance on customer C's T account, all in all, our total will be 60,000 accounts receivable, and this is not acceptable. The credit balance on accounts receivable cannot be offset from the other debit balances. So what do? We adjust the entry, or we adjust the T account. We debit accounts receivable of customer C of 20,000 and credit to advance payment from customer C as a current liability of 20,000. So on our financial statements, we will report accounts receivable of 80,000, which is customer A and customer B, and current liability of 20,000. And this I want you to learn from receivables.